How to negotiate pre and seed equity, pre-seed and seed equity. That's confusing, but I didn't have the space to write out, or I was too lazy to write out pre-seed and seed equity. So how do you negotiate pre-seed and seed equity? This is a question that I get hit up with quite often, actually, maybe a few times a day or a week. And I wanted to give a quick lowdown because when I go watch different types of videos on this and instructions, it gets so confusing because there's all these factors and it goes through all these numbers and everything like that. So what I'm going to do is break down the mechanics of pre-seed and seed equity, and then I'm going to leave it to you as a founder to go research more. There's lots of templates and different things that you can do to figure out how to calculate your cap table, template spreadsheets, Excel, etc. And I'm going to give you the primer on how to look at these things so you understand what pre-seed and seed equity looks like. And so we can just circulate this video and say, hey, watch this video, and then let's talk if you have some direct questions. So pre-seed and seed equity, here we go, buckle in. So first thing that you have to do is understand founder equity right in the beginning. All right, so everything comes around founder equity. Now, sometimes what people do is they formulate, or founders do, is they formulate using an LLC or C Corp. So let me explain the difference. An LLC and a C Corp are different in the sense that an LLC does not have shares, no shares. The LLC is cheaper to set up, manage, do taxes, etc. But the C Corp has shares. So what happens is when an investor comes in, they typically want to get shares. So you're going to have to convert into a C Corp. That's how it works. So here's the thing. If you're not sure that you're going to raise money, or you are severely cash strapped in the beginning and you want to generate some money or different things like that for, like, let's say 1 to 2 years, go LLC. And then you can raise enough money to convert C Corp. Here's the thing, it costs the exact same in the long run because a C Corp already has the shares. And if you're sure you're going to raise money within the year, or let's say within 2 years at least, before you have to do all your taxes and things like that, by the 2-year mark, then just go do a C Corp. It's going to save you a ton of headache later on because all the paperwork to go from LLC to C Corp. However, you can always just create a new corporation. Now, here's what you have to think about. So then what happens if there's co-founders, right? So I'm going to give you the 2 scenarios of co-founders. So let's say LLC, and you have, okay, let's do, you have 4 co-founders, and I'm going to just give the examples using a lot of co-founders because who knows, you might as well just factor all that in. All right, so let's say you have 4 co-founders. In an LLC, the 4 basically become, they're like members of the LLC, and everybody is equal unless you have an operating agreement that says I get certain amount, etc. Some states want an operating agreement, etc. This is agreement between all the co-founders of an LLC and how they're going to manage things together, all this stuff. But let's just say 4 are equal. You're not going to have any problems. Everybody shares in the liabilities as well as the taxes when it comes out there. And it's just like people get their distributions and what have you. Go and talk to an accountant on how that works. But there's an operating agreement, and then there's a future equity agreement or some type of co-founder agreement that says, all right, when we become a corporation and when we take in money, etc., you are going to get equal amount of shares. We're all going to be equal. That's how that works. Now, in a corporation, going to change colors here, you do that all up front. So what happens is, let's say you establish a corporation. Corporations create a share structure in the beginning. And here's the thing, you want to allocate your shares in the beginning, because when a corporation begins, you can all say, my shares equal something ridiculously low. I forget what I do, but I go, all the shares are equal 0.0001 cents a piece, because a share is an asset. And when you get an asset worth something, you have to pay taxes on it, right? So you want to make those shares worth pretty much absolutely nothing. So let's say you start your C Corp and you got 4 co-founders. You're going to do a share structure, and what you want to do is you want to get into share structures that have millions of shares. And the reason is, if you're going to take millions of dollars in, well, you want a share structure where your shares go pretty much under $1. You don't want to be getting into anything where shares go above $1 or less, depending. And it just makes everything a lot easier to think about and to evaluate, etc. You could go Berkshire Hathaway and say each share is worth $250,000 or something like that, but that's just an obscure example. So let's say you have 4 co-founders and each get 250,000 shares. Okay, and so equals 10 million shares. This is your cap table. That's how it works. Why am I going through all this? Because it's going to matter a lot when you take your first investor. Now, remember, your company is basically worth $0. $0. You are worth nothing, and you want to be worth nothing because of taxes. And that's where you get to have the fun conversation with co-founders. And by the way, 250,000 shares a piece, if this thing goes to unicorn status, well, you do the math on what the company is going to be worth. So if you're worth $1 billion and everyone has 250,000 shares and it's split 4 ways, well, that's really expensive. So you want to make sure your co-founders really deserve the equal amount of equity, while at the same time, you get the right co-founders. I want everybody to be equally incentivized. That's a whole other video. Ask me for it. I've got one in our playlist in terms of how to allocate shares and ownership within co-founders. But for now, you have 10 million shares. That's how it works. All right. So we're starting off. We're going to say, all right, let's say you are a C Corp, or you're just about to be a C Corp. And here we go. You're going to go the pre-seed round. Pre-seed round. Here's the thing with pre-seed round. Pre-seed rounds are typically, in startup land, friends, family, and associates, or what I call the fool's round. And it's not that people are dumb. It's just that it's really foolish. It's a dumb idea to invest in a company at a pre-seed round using traditional models, mindsets, traditional approaches. But that's where all the money's made, right? It's the asymmetric upside that you YOLO or FOMO your money in at a pre-seed round, and it becomes a unicorn. Guess what? You are worth a boatload of money. Case in point, go see, what's his name? I totally forgot his name. The guy on the internet who invested in Coinbase right in the beginning. $300,000 became $1 billion exit or something like that. Like that's how that worked. All right. So now what you are going to do is ask an investor in a pre-seed round, which is before you have product or before you have any type of meaningful demo or validation in the market. Basically, your company hasn't done anything. You just have an idea and you've started to build something, but you don't know if it's going to work and it's super risky. This is the reason we call friends, family, and associates / fools round, because the only pre-seed investors out there from a professional standpoint are pre-seed micro VC or accelerators, but typically they've got their own terms and they are looking for traction. I know. They say, oh, we'll invest in pre-product and ideas, but your idea better be whopping good. Very, very small percent, less than 1% get money at the idea stage. So pre-seed round, you're going to be talking to a rich uncle or your lawyer's buddy who happens to, I say all the time, bought Bitcoin at $3,000 and cashed out at, what is it now? Just under $40,000, et cetera. That means evaluations are totally up to your negotiating power. So there's no hard and fast rule. It all depends on what you can convince and the value and everything like that. But you play some funny games at the pre-seed round and you have people on your cap table. I'm warning you ahead of time. Later on, investors come and say, how did, Joe get preferred shares and your uncle Bob has this shares and this contract? Everything gets messy. There's due diligence and everything gets super expensive for later rounds. That's where things get sticky. So be careful. Messy cap table is bad for future investment, for the future. Okay. For future investment. So that's the reason you want to try and keep things as clean as possible. And so it's up to your negotiation. Let me just erase this here. Okay, so what do? We're going to negotiate. Now, unless there's terms, you might go to an accelerator or an incubator that says, all right, we give you this for you to build your idea, but we want X% of the company. I'm not going to get into that because they're all established, but they're not the same as Uncle Bob or Billy Joe or Billy Joe Bob or Mary Sue, right? So it's going to be a negotiation. And they're going to want to invest in all sorts of different ways and valuations, et cetera. I don't know what's going to happen. So let's just say that you go out and you go get $1 million. All right. And again, the average pre-seed round from a professional perspective is $500,000. But I'm going to venture to say that most founders that I see when they're doing friends, family, associates round, $200,000 to $300,000 seems to be the average round. But it can go up there. I've seen founders go and get $1 million, $1 million pre-seed. So that's talking and having rich friends, etc. So let's just say that you go get $1 million pre-seed, $1 million, right? Now, how does that look like? What does that look like? Well, you're going to have to decide pre-money or post-money evaluation, which is going to be the interesting thing, pre-money or post-money. Again, do your research on this. But let's just say, for example, typically in a pre-seed round, people want more equity up front because there's more risk. But it's not really equity that you're going to get in terms of, you're going to give in terms of real smart money, different things like that. It's probably just someone who's going to help you build your product, etc. Maybe you get a, very, very generous, very excited micro VC that says, we're going to, or an angel group or something like that, we're going to give you $500,000 now pre-seed, and then when you build it, we'll go $500,000 in seed money. I've seen deals like that. But let's say you have $1 million and you negotiate that they want 10% of the company. They get 10% for 10% of the company. Well, let's think about this here for a second. All right. If you're saying 1 million for 10% of the company, then what's going to happen is, let's just say that with post money, so meaning that with the money inside, so post, the company is going to be worth $10 million for 10% of the company, right? So that's how that works, $10 million. That means that pre-money, you got them in at 9 million, okay? And you got to figure out the shares on $9 million valuation. All right, so that's a little bit of a math lift. Let me switch it around here. And I know this is getting confusing all around. You want to say, okay, let's say that pre-money evaluation is 10 million bucks. All right, so this is the simple math way. So pre-money, so don't get burnt on post-money and pre-money, because those terms can come in. So pre-money evaluation is 10 million. All right. So guess what? 10 million for 10% of the company, 1 million. That's how that works. Okay. So because 10% of the company, 1 million times 10 for 100% equals $10 million. Well, does that mean every founder goes and sells their shares? No, because guess what? If you sold your personal shares to somebody and you had 10 million shares in the company and you sold 1 million shares at $10 million of valuation, well, guess what? Your shares are worth $1 each. Your shares have gone from 0.0001 to $1 each. That's a taxable event. So you don't do that. Well, what do? Well, I say, all right, so I'm going to come in and there's 10 million. Let me change colors here. Okay, so 10 million existing shares. Sorry, penmanship, existing shares. You are going to add 1 million shares. So that creates 11 million shares. 11 million shares. So nobody's selling any shares, and that means everybody then gets diluted, right? And so they don't own as much of the company anymore. So if every founder used to be 25% owner, and now they are not 25% owners, because guess what? Someone came in for 10% of the company. So do your math right there, right? So if that you are all 100% owners, and now you come in, the 4 co-founders are 90% owners, and guess what? Now you're all 22.5% owners. So like I said, there's spreadsheets out there that you can go and take a look and figure out how your ownership is going to get diluted. So every time you bring in money, you add more shares, but it's called dilution. You dilute your cap table and the ownership. But guess what? Now you're worth post money. Okay, so pre-money was 10 million. You add 1 million. Guess what? Your post money is now $11 million. Yay. Okay, not liquid. Can't put it under your mattress, etc. So don't go buying a Ferrari or Lambo just yet. Post money is 11 million. There's 11 million shares. Every share is worth $1. Congratulations. That's how that works. So that's going to be something that the founders want to do, where they say, okay, I'm going to get 10% of the company. But here's the thing. What if you're on a rocket ship and your company is going to be worth $40 million later on? You don't know. Nobody knows these things. And this is the reason I say it's based on your negotiation. And I don't know what your investors are going to want. I don't know what they want. They could say, you know what, for this is where you get in Shark Tank mode. This is where Shark Tank, I can't stand Shark Tank, by the way. I really enjoy the entrepreneurs. I can't stand the negotiation, because what they're doing is they're kind of treating everybody as pre-seed startups, but really they're not startups, because it's just like traditional banking. All right. So people coming in and negotiating, wheeling, dealing, and, I'll take for whatever X% of the company. Startups don't act like that, because you just don't know the valuation of the future. This could be unicorn. Investors know that in startup land, so they don't want to hammer you and make you feel bad, so you're not motivated to build your unicorn. So that's the reason Shark Tank is just not a good, it's not a good example. Don't watch Shark Tank to figure out how you're going to be negotiating pre-seed and seed equity. Just fair warning, no Shark Tank. Okay, cut it out. Stop watching Shark Tank. Stop it. I know you're watching. I know you're watching right now. Stop it. Okay. So let's say what we want to do is invest in oh, you know what? I'm going to do it the other way. Okay. Let's say there are two ways to invest without an evaluation, and that is a convertible and a SAFE. SAFE stands for, I'm not going to write it out because I'm lazy. SAFE agreement. Simple agreement for future equity. And I'll show you how these two work, because safes are getting popular, but they're not totally well known across the board. A convertible is a debt that converts. So let's say this investor comes in and says, I'm going to give you $1 million, but your debt says that it's going to cost you, I don't know, 5 to 10% over 24 months. All right. Now, I've seen different numbers. I've seen it go down as low as 2%. And I've seen people say, don't give more than 7%. Again, this is all your negotiating power. This is totally up to you. It's going to depend. And so that's the reason us as advisors, we can't tell you. We can only tell you, well, typically investors want to see this amount of ownership at this point in time. And let me give the cat out of the bag. At a pre-seed, who knows? I've seen everything up to 10%. So we're going to say up to 10% in pre-seed. And then seed typically, get ready, typically equals 20% ownership. They want 20% ownership. And what's the reason for that? Is because when you invest in seed investment, did I say pre-seed? Seed investment, pre-seed up to 10%, seed 20%, around there. In seed investment, what happens is they say that, well, I'm going to give you a seed, but if you go unicorn, A, B, C, D, E rounds, I don't know how many rounds you're going to go. Well, they get diluted all the way down to single digits. And so their exit, when you exit for $1 billion, might not be as good as they thought. So pre-seed comes in early, and the seed says we want 20% because we're expecting you now. If you've gotten to a place where you can get a seed, well, you probably have the potential to be one of these future unicorns, even though I believe less than 1% actually, 1% of startups get to that sort of scale up phase. But you never know, you might exit for $40 million or $30 million, who knows? So that's how it works. Now, a lot of organizations like angel groups or micro VCs, what I've seen is they'll say, we're going to take 10% at the pre-seed round and then another 10% at the seed round if you can build your product. So then we get 20%. They might do that. Again, they are out there. It's up to you to find them, and they're going to tell you their general terms, and they're going to be asking you, and they're asking you to kind of give you a test on what you're thinking. So you want to make sure that you kind of know the general standards, and you don't get greedy in the beginning, because guess what? The fact that you can actually attract pre-seed or seed investment sets you apart. So beggars can't be choosers, just like but also avoid predatory deals. I know, tough balance. But let's get back to convertible. So it's going to be a debt, and in 24 months, I'm making I'm making 5 to 10% of my money. And then I'm going to erase this 2 to 7%. So I'm just going to 5 to 10%. So let's do that here. And then guess what? At 24 months, there's an event, a conversion event that says, what are we going to do? Either you're going to pay the money back, your company's going to shut down, or you're going to convert it into equity at 24 months. So that's how that works. The problem is, what happens if you're not ready at 24 months to convert equity? This is where convertibles kind of got wonky, but although there's a lot of mechanics to it, it does make sense for investors because they're making money on their money while they go in. And then when they convert, there's typically what's called a discount plus a cap, an evaluation cap, whichever is cheaper, whichever is going to get them more shares. So they may say at the time the equity, my money's going to convert at a 20% discount or 10% discount. I've seen it all over the map, between 10 and 20%, or a cap, you're going to max out at $10 million valuation or something along those lines, right? Whichever is going to get you the most shares. Now, here's the thing is the convertible, the interest, when it does convert, they're not converting $1 million into your equity. They're converting 1 million plus 5 to 10% for every year. So let's say it's 5% and you convert it at 22 years, 24 months. Well, it's $1.1 million that gets converted. So their money's working for them and they convert plus discount and cap. Now, the discount is, say your valuation is lower than $10 million, which is, say, the cap, right? Let's say the cap was $10 million and you end up raising at $5 million. Well, their 20% discount is going to go a lot further than the cap price at $10 million, because let's say you end up raising at $20 million. Well, this allows you to go and build your company and create the valuation, but the investor gets protected because they're not going to get blown out of the water and they're going to raise at $10 million. I know, complicated, but you can go do the math yourself and figure that out. I'm just giving you the primer so you can go find the research and you at least know these terms so you can figure that out. So that's the convertible. So I'm just going to erase all this stuff and I'm going to show that the difference between debt, so convertible, and then the safe. Here we go. Once again, convertible, they give you some money and then they charge you interest over 24 months or typically 24 months. And then there's going to be a discount or a cap on the conversion event, right? Discount or cap, discount and or cap, right? So yeah, let's just do this for posterity's sake. There's discount plus cap, right? Don't, I've seen founders end up giving a discount at the cap, like it and the cap together. This is discount or the cap. So it's in your contract, whichever is cheaper. Just forewarned here. Now, here's what happens is a safe basically is a debt. And then there's a discount or a cap. That's it. And it's a standard agreement. These are super cheap. They're chap, if I'm using my spelling, cheaper, it still costs money. So that's the safe round. There's templates out there. Quite frankly, I've done safes and I've used no legal whatsoever, just simple agreement and bang, in there, because you have all that time to work it out. When you get into the equity round, that's when things go due diligence, because the equity round is when someone comes in and says, all right, congratulations. Now I'm going to give you $5 million at whatever $40 million evaluation. And we're going to do an equity round. Then everybody converts and you do all your due diligence and everything at the same time, which is the reason we tell founders do some type of convertible, which is more expensive, or a safe. Do the convertible if you want the ability to pay back. This is another example. Sometimes you may want to pay people back and say, hey, we're off to our races. We got good financing. Here's your money plus 5 or 10%, whatever, right? Now, that's where things get super interesting and depends on the contracts. I'm not going to get into nitty gritty of that. But the safe is super simple because let's not worry about the valuation. Let's just work super hard. Give me some money because we're in it for the long haul and we're in it for the long game. And that's the reason when you do friends, family, and associates, some are like, oh, when do I get dividends? And when can I sell my stock? And all that stuff. And that's when they're looking typically from a traditional small business investment. They're not the best for startup investors. And that's the reason you see all these fancy, funky, weird deals on Shark Tank and all this stuff. A startup investor, a professional VC would never make a deal like you have on Shark Tank. That's the dumbest thing ever. And so again, stop watching Shark Tank. Okay, don't do it. All right. So that's the difference between a convertible and a safe. But again, the whole purpose is no clean cap table in the beginning and understand what dilution looks like. You're not selling your personal shares. That's not what happens. You're adding more shares and then there's whole dilution, etc. And at the pre-seed round, it's going to be all about negotiation. I have no idea what evaluation is. Okay, maybe around 10%, maybe 10 to 20%. I don't know. But at the seed round, you're typically talking to some type of professional investor. They're going to want around 20% of the company. That's typically what you do. Do yourself a favor, go in there and start thinking 20% of the company. So that means you can, if they're good for it, ask for more money if you think you can justify it, etc. But that's where it's like, oh, can I take less money and give them less ownership? It doesn't work that way. At seed round, they want, if they really believe that you're going to be rocket ship unicorn, baby unicorn riding in a rocket ship, going to the moon, hockey stick graph, they're going to want 20% of the company. So just think it through and figure that out. So there's your intro to pre-seed and seed investment, and then LLCs, corporations, safes, and convertibles. That should get you started to learn. So at least you're comfortable with the language, and then go out, do your own research, do your homework on that, and figure out how to learn, because this is the business of business in being a startup founder. And you're going to have to learn these things so that you're not sitting there embarrassing yourself or getting very insecure and letting someone gaslight you and talk you out of a deal or talk you into a really bad deal. As they say, if you don't stand for something, you're going to fall for anything. So learn your terms, learn how to do this, and make sure you reach out if you need some more fine tuning. Hope this has been helpful.